Let's explain private debt using four main categories: direct lending, mezzanine loans, venture debt, and distressed debt. Direct lending is just private lending to companies in the form of loans, as opposed to equity. Mezzanine loans sit subordinate to senior secured debt, but are senior to equity holders. So in the event of a bankruptcy, your senior secured debt would get first claim on assets, then your mezzanine loans, then your equity holders. Venture debt is a loan to a growing company, usually a startup or a smaller company, that has low or negative free cash flow. Most of the time, this loan will be convertible to equity or have some sort of equity upside. Distressed debt is a loan given to a company that may have a difficulty meeting its debt covenants, or maybe in the process of bankruptcy, or is basically distressed in some way. Private debt targets similar companies to private equity. A lot of times, it's the same company, just a different part of the capital structure, debt instead of equity. In contrast to a traditional commercial loan, private debt offers a lot more flexibility. Private equity firms are able to leverage their relationships with target companies to offer them credit solutions. Because of this, private equity firms have been able to raise private debt funds, sometimes really large private debt funds. For example, KKR, in the beginning of 2018, announced the final closing of its new credit fund called KKR Private Credit Opportunities II, which raised $2.24 billion to focus on privately negotiated subordinated debt securities, corporate mezzanine investments, and asset-backed and specialty finance investments.